Who has it right when it comes to the economy, the bond market or the stock market?
Well, I would say both, but I know that's a cop-out of an answer. But I think heading into this report, there were expectations that the weather or the number would be softer than even consensus expectations of economists. So I think the bond market is reacting to that. What I would interpret the stock market as saying is this number is indicative of a fairly healthy and robust and resilient U.S. economy. But an uptick in the unemployment rate to 6.7 would signal that rate hikes are well off into the future, so the Fed can be patient in how it backs out of its accommodative stance. So that's how I would interpret the difference in reaction between the two markets.
You know, Michael, Janet Yellen, of course, has been trying to massage us here as the rate headed towards 6.5%. So how does the uptick in the unemployment rate change the message, change the tone of the Fed?
So I don't think it changes the overall tone, but what I think it'll raise the issue of, do they need to move away from their quantitative thresholds in the statement to something more qualitative. They've clearly sent the signal that we would like to move to something more qualitative in nature, just verbal guidance that we're going to let the unemployment rate fall as long as we can until inflation starts to rise. So at 6.7, it moves, obviously, you're 0.2 away from the Fed's 6.5% threshold. So it could buy them more time to make a change, say, around June or maybe even in their April meeting. But we expect there'll be momentum to make that qualitative change in the forward rate guidance at the March meeting. So all else equal, it would buy them more time if they need it.